People love Jollibee. It's part of our culture, our childhood, our comfort food. But when it comes to investing, you have to ask one hard question. If Jollibee keeps expanding, why isn't its stock price going anywhere? Because right now, even if the company is opening more stores, acquiring more brands, and buying into more global markets, the people who actually own the stock, the shareholders, are not seeing real returns. And that's not just a Jollibee problem. That's a Philippine stock market problem. Let's look at the numbers. Jollibee stock today is hovering around 186 per share. That's down sharply from just a few months ago and way below its all-time high of around 1,300 several years back. Since then, it dropped, slightly rallied but never recovered. Despite all the headlines about expansion, acquisitions, and global ambitions, the stock keeps sinking lower. Think about that. While Jollibee keeps buying new brands, Coffee Bean, Smashburger, Tim Hawan, the people who believed in the company the most, the investors, are left holding the bag. Now, compare that to the giants of the global food world. McDonald's up massively over the past decade. Yum Brands steady dividends, consistent buybacks, and shareholder growth. Starbucks, even with higher costs, it's still one of the best performing restaurant stocks in history. Chipotle, its stock has exploded in value since the pandemic. It has corrected as of late, but it is still a better proposition than Jollibee as a stock. And Restaurant Brands International, the company behind Burger King and Tim Hortons, continues to grow while rewarding shareholders while expanding at the same time. The key difference? These companies grow and have massive capital appreciation, and they give back. They raise dividends to a point that people feel it and it's competitive. They buy back shares. Their profits scale. Their stock prices move up, not just move up, but move up in a way that it is life-changing. It's not just about more stores or more branches. It's about real value creation for investors. Investors that believe in the company and also have dreams of financial freedom. Jollibee, on the other hand, dividends are low, roughly 1% yield. The share price is falling, not just falling, but it has failed long-term investors. They say invest for the long term, but Jollibee has not rewarded long-term investors. And while management loves to highlight expansion and brand building, shareholders are left wondering, where's the reward? It's like watching someone brag about all their new businesses. But none of them are actually benefiting people who were early investors. Expansion doesn't always mean profitability. And in Jollibee's case, it hasn't meant shareholder wealth. Some people will say, just be patient, it's long term. Sure, but how long do you have to wait? Because here's the truth. The Philippine stock market has been underperforming for years. The PSE index peaked near 9,000 back in 2018. Today, it's struggling to stay above 6,000. That's a decline of more than 30% in 7 years. Factor in inflation and peso depreciation, and the real value of your investments has gone backward. Why is this happening? Because it's not just about Jollibee, it's about the system. We have a small, illiquid market, a handful of conglomerates dominate everything, policies that push away foreign investors, bureaucracy that kills innovation, and corruption that eats into progress. It's a system where growth stories sound great on paper, but the people who invest their money rarely see the rewards. If you had invested in McDonald's 10 years ago, you'd be sitting on more than 200% total returns, including dividends. If you had invested in Jollibee, you'd be down from your peak and flat or negative in real terms. That's not bad luck. That's what happens when markets don't prioritize shareholders. Now, to be fair, Jollibee is still a great brand. It's bold, ambitious, and truly Filipino. But as an investment, it's underwhelming. Because the company keeps growing its footprint, but the stock keeps shrinking. Margins are thin, debt is high. And profits are not scaling at the same pace as expansion. If the country's most iconic company can't deliver strong returns to its investors, what hope do the others have? That's why smart investors are rethinking everything. You don't have to stop being proud of Filipino brands, but you have to be strategic with your capital. The opportunities, the real ones, are outside. In markets that reward innovation, in companies that share profits, in economies that are growing, not crawling. It's not disloyalty, it's self-preservation. Because if you keep your money stuck in a stagnant market, you're the one who pays the price. Let's be real. If you invested 100,000 inches Jollibee a few years ago, you'd be down today. If you had invested that same amount in McDonald's, Starbucks, or a global ETF, you'd be up double or even triple. That's not luck. That's structure. That's how mature markets protect investors. Then it's time to go where the value is. Invest in companies that make sense, in markets that move, in systems that actually protect you. Because loyalty to a stagnant system won't make you rich. This is Stock Smarts reminding you, don't just invest in what's familiar, invest in what works. If you got value from this, like, share, and subscribe. Let's help more Filipinos wake up to the truth. Your money deserves to grow, and sometimes that means growing beyond the Philippines. In investing, go where you're treated best. Look for low fees, strong governance, and true shareholder alignment. Favor companies that return cash, healthy dividends, and disciplined buybacks. Diversify globally, don't marry a flag. Marry results. Follow incentives, profits, and rules that protect minority investors. Your money deserves respect. Move it until it gets it.